time value of money is in the heart of every decision that we take in finance, including business valuation. And in my experience, I realize that without good understanding of time value of money, it is really very difficult to arrive at the decisions in the domain of finance to find out as to what is your cost of capital. And if you're not able to find out your cost of capital, remember any decision in finance, whether regarding organic growth or inorganic growth or valuation or merger or acquisition or intangible assets or fixed income securities or option valuations is just not possible. And therefore, as valuation professionals, we really ought to have a good understanding, good in-depth understanding of time value of money. Time value of money, remember, can be understood in two ways. Number one is compounding, and number two is discounting. So, what is compounding? Compounding is to find future value of current present cash flow. So, compounding would mean to find out future value of present cash flow. And then you have a discounting. And what is the meaning of discounting? Meaning of discounting is the other way around. So in case of discounting, what you do, you try to find out the present value of future cash flows. And that is one thing that we need to understand for forever. So there are two aspects to time value of money. One is compounding and second is discounting. Now, compounding would mean what? So compounding will have four aspects. Number one, to find future value of a single cash flow. Number two, find future value of multiple cash flows. And number three, to find future value of an annuity. And number four, to find the sinking fund factor. Sinking fund factor. And when it comes to discounting, now what would we find in case of discounting? So number one, we will find in case of discounting is the present value of a single future cash flow. Number two, what we would find is the present value of multiple future cash flows. Number three, what we will find is present value of an annuity. And number four, what we'll find is capital recovery factor. What is capital recovery factor? What is sinking fund factor? What are their applications and uses? We would keep understanding as we go on. But for the time being, let's understand what is the meaning of annuity. And please remember, meaning of annuity is of course very simple. Meaning of annuity is a cash flow. Meaning of annuity is a cash flow where the amount is fixed, period is fixed, interval is fixed, and interest rate is also fixed. So when you have, in case of a cash flow, when you have these four things fixed, it is an annuity. So when the amount of cash flow is fixed, that means every time it is the same amount of cash flow that will happen. Inflow or outflow, it doesn't really matter, because annuity can be with regard to inflow, annuity can also be with regard to the outflow, doesn't really matter. So long as there is a cash flow, there can be an annuity. When will it become an annuity? It will become an annuity when the amount of cash flow is fixed, the period for which this cash flow is going to happen is also fixed, the interval at which this cash flow will happen is also fixed, and the interest that will happen on this cash flow is also fixed. When these four factors are fixed with regard to one cash flow, that cash flow is known as annuity. And I'm repeating it once again. Please remember, annuity can be with regard to the inflow or it can be with regard to the outflow. Doesn't really matter. So long as there is a cash flow and these four factors are applicable, that is an annuity. What is a perpetuity? Perpetuity is annuity without fixed period. So please remember, in case, what is the common thing between the perpetuity and annuity? The common thing between the perpetuity and annuity are three. Number one, the amount is fixed. The amount of cash flow is fixed. Number two, the interval at which the cash flow will happen is also fixed. And number three, the rate of return or rate of interest on that cash flow is also fixed. So these are the three common factors between the annuity and the perpetuity. What is the uncommon factor? The uncommon factor is the period. Meaning what? Meaning In case of an annuity, there is a fixed period. That means annuity will run for certain amount of period. It can be 4 year, 5 years, 6 years, 7 years, or whatever. But annuity, remember, there is no fixed period. Sorry, perpetuity, remember, there is no fixed period. Perpetuity is for infinity. It is for infinity. And that is the difference between the annuity and the perpetuity. Let us now understand compounding and discounting one by one, all aspects of compounding and all aspects of discounting one by one. But as always, before we do that, let me throw it open to all of you in case if you have any question, any doubt on these aspects of time value of money. Please go ahead.